The sun rises over the Las Vegas Strip, casting long shadows from the iconic skyline. This is the city of constant reinvention, a place where fortunes are made and lost, not just at the tables, but in the sprawling suburbs that stretch into the desert. Today, October 2025, a fundamental shift is underway in one of the nation's most watched housing markets. The question now is not how high prices can go, but how far they might fall. Welcome to the Real Estate Watchline special report, where we dissect the data to answer one critical question. Has Las Vegas become a buyer's market? This report is timed for a crucial moment. The frantic post-pandemic boom has given way to a palpable sense of caution. For months, whispers of a market slowdown have grown louder, but now the evidence is undeniable. October 2025 represents a turning point, a month where key indicators have aligned to signal a new chapter across the valley for buyers, sellers, investors. We will examine why this period matters, analyzing the confluence of rising inventory, cooling demand, and external economic pressures. This is not speculation, it's what the numbers say right now. We'll use a data-first approach. Visuals include clear charts, detailed satellite maps, and interactive data dashboards, from Redfin to the Clark County Assessor. We'll journey through the city's diverse neighborhoods, Summerlin, Henderson, and the bustling urban core. Expect data of homes for sale, construction sites, and daily life across the metro. The central theme: a dramatic power shift from sellers to buyers. After years of bidding wars, waived contingencies, and record-breaking price appreciation, the tables are turning. We'll show what a buyer's market looks like on the ground: an increase in active listings, a growing number of price reductions, and newfound negotiating power for buyers. If you're buying, selling, or investing in Las Vegas real estate, understanding this transition is essential. The Great Vegas Housing Reset has begun. The story of the Las Vegas housing market in October 2025 is told most clearly through the data. The headline statistics paint a picture of a market undergoing a significant rebalancing act. Key Las Vegas real estate metrics for October 2025. Median home price: $470,000, which is down 3% year over year. Active listings are up 37% year over year, and average days on market 52 days. The median home price now sits at approximately $470,000. While this figure represents a modest year-over-year decline of 3%, a stark contrast to the double-digit gains seen in previous years. More telling, however, is the explosion in housing supply. Active listings have surged, climbing an astonishing 37% year-over-year. This influx of homes for sale is the primary driver behind the market's shift, giving buyers something they haven't had in years: choice. The expanded inventory is directly impacting how long properties linger on the market. The velocity of the market has slowed considerably. The average days on market for a single-family home has stretched to 52 days, more than double the time seen during the peak frenzy in 2022. With current mortgage rates hovering around 6.8%, buyer affordability remains a significant hurdle. Sales volume has reflected this pressure, with closed sales down 12% compared to this time last year. The days of multiple offers flooding in within hours of a listing are now largely a memory. When we compare the current market to prior peak years, the cyclical nature of Las Vegas real estate comes into sharp focus. The last major peak in 2006 was followed by a dramatic crash, but today's scenario is different. The current cooling is less of a collapse and more of a controlled deflation, driven by interest rate policy. Unlike the previous cycle, lending standards have remained relatively tight. Still, the psychological impact is similar. The market has moved from irrational exuberance to calculated realism. Fundamentals like income. Fundamentals like job growth. Fundamentals like affordability. The rental market provides another layer of context. Rents are beginning to cool across the Las Vegas Valley. The average rent for a two-bedroom apartment has fallen by 2% year over year, and the vacancy rate has ticked up to 6.5%. This trend reduces the pressure on potential homebuyers. With more available and slightly cheaper rental options, many households are choosing to wait for more favorable buying conditions. That further contributes to the softening demand for home purchases and reinforces the market's shift toward buyers. The market slowdown is not being felt uniformly across the Las Vegas Valley. A closer look at neighborhood-level data reveals a more nuanced picture. The luxury segments are softening. Master-planned communities that saw big price gains are softening. Areas like Summerlin are showing the largest shifts. Higher-priced sections of Henderson are also softening. Those areas were hotspots for out-of-state cash buyers. They're now seeing big increases in inventory and significant price reductions. Homes priced above $750,000 are sitting on the market longer. Sellers in that bracket are more willing to negotiate on price and terms. That's a clear sign of a cooling market. Conversely, North Las Vegas neighborhoods are more resilient. The eastern parts of the valley show similar resilience, but they're not entirely immune. Demand from first-time homebuyers remains relatively steady. Local workers are still buying at similar rates. Accessible price points are supporting that demand. However, the surge in overall inventory gives buyers more options. Buyers are facing less competition. We're seeing fewer bidding wars. There's an increase in seller concessions, contributions toward closing costs, rate buydowns. Even homes priced below the median are getting concessions. This shows the shift is pervasive, though intensity varies by location and price point. For example, the 89135 zip code in Summerlin has seen a 45% increase in active listings year over year. By contrast, the 89104 zip code has a more moderate 25% increase. That disparity reflects different buyer profiles. The discretionary, equity-rich buyer has pulled back. The primary residence buyer, driven by necessity, is still active, but with more caution and less buying power due to higher rates. Neighborhood-specific data is critical for spotting opportunities and risks. Headlines may call it a buyer's market, but on the ground it's more complex. The one-size-fits-all approach no longer works. Success requires deep knowledge of the specific micro-market. The first and most fundamental problem is the severe disconnect between home prices and local wages. While the median home price has softened to $470,000, it remains stubbornly high relative to the earning power of the average resident. The sticker shock is palpable for many families who call this valley home. Years of rapid price appreciation have created a formidable barrier to entry, pushing the dream of homeownership out of reach for a significant portion of the workforce. Hospitality, service industries. This is not just a statistical issue. It is a growing social and economic strain felt across the community. The current price-to-income ratio stands at a level that is historically unsustainable for a market like Las Vegas. This imbalance means that even with 2 full-time incomes, many households in these fields struggle to qualify for a mortgage. The problem is exacerbated by the fact that the market was largely driven by external demand for several years. Cash-rich buyers from more expensive coastal markets could easily meet Las Vegas prices, which seemed like a bargain in comparison. Now that this wave of external demand has receded, the market is left to contend with a price level that the local buyer pool simply cannot support. The second major problem is a dual-sided issue stemming from the rental market, which is simultaneously becoming a more attractive alternative for residents and a less profitable venture for investors. For potential homebuyers on the fence, this development significantly reduces the urgency to purchase a home. This trend directly saps demand from the for-sale market. Compounding this issue is the recent crackdown on short-term rentals. The stricter zoning, licensing requirements, and density caps implemented by Clark County have made the lucrative business of running an Airbnb far more difficult. This has forced many to sell them altogether. The wave of former short-term rentals hitting the for-sale market has been a major contributor to the 37% surge in active listings. The third problem, tourism, is softening. LVCVA Q3 2025 data shows declines. Visitor volume is down 4% year over year. Convention attendance is down 7%. Immediate knock-on effect, employment. Hotels reduce staffing. Restaurants cut hours. Job insecurity becomes pervasive. Uncertain employment deters home buying. The fourth problem facing the market is a heightened sense of volatility and unpredictability. Price discovery has become a major challenge. Sellers are struggling to price their homes correctly, leading to overpriced listings that stagnate. This constant downward adjustment of prices creates uncertainty for buyers who wonder if they should make an offer now or wait for prices to drop even further. This volatility is also reflected in the growing number of deals that fall through before closing. The pressures in the housing market are not occurring in a vacuum. They are a reflection of and a contributor to broader economic strains now visible across the Las Vegas Valley. New construction permits for single-family homes have fallen sharply, down nearly 30% versus this time last year. Airport traffic is mirroring the tourism slowdown. This slowdown has significant fiscal implications for local and state governments. Weaker revenue can delay or cancel public investments. That can diminish neighborhood appeal. As we look ahead, the Las Vegas real estate market stands at a critical juncture, with several plausible scenarios that could unfold over the next 6 to 18 months. The most likely path is a continued gradual cooling, followed by price stabilization. This path represents a soft landing, a market reset without a catastrophic crash. However, a more pessimistic scenario cannot be discounted. If the national economy slips into a recession, the impact on Las Vegas would be severe. We could see double-digit price declines. On the other end of the spectrum lies the possibility of a modest rebound. If inflation cools faster than expected, we could see a rapid return of buyer demand. In the end, the data paints an undeniable picture. As of October 2025, the Las Vegas housing market has fundamentally shifted. The era of frantic bidding wars and unchecked price escalation has given way to a period of sober rebalancing, firmly placing negotiating power back into the hands of buyers. This is not the catastrophic crash of 2008, but rather a controlled deflation, a market letting air out of a balloon that was stretched to its absolute limit. The risks moving forward remain significant, yet within these challenges lie clear opportunities. For the patient and well-positioned buyer, this market represents the best chance in years to purchase a home without the intense pressure of overwhelming competition. Las Vegas has a long history of reinvention, and this market reset, while difficult, is a crucial part of that cycle, clearing the way for the next phase of growth. This current housing market reset is simply the latest chapter in that ongoing narrative. It is a necessary correction that is recalibrating expectations and restoring a measure of balance. The Great Vegas Reset has indeed begun, and for those watching closely, it signals not just an end to a frenzied era, but the beginning of a new one defined by caution, opportunity, and an eventual return to stability.